move on to the mutual fund space, where Dhirendra Kumar is waiting by to address all your queries. Looks like the mutual fund industry, in fact, is back on the growth track. August witnessed an average rise of 3.3% in assets under management, and the 5% tax on equity funds hasn't had an impact yet on the AUMs as of now. Let's ask Dhirendra Kumar whether this is what are the best funds rather to invest in a situation like this. Dhirendra, what's your sense? No amount of impact, in fact, your growth in AUMs. What's your sense in a market condition like this? Start investing?
No, I think most individual investors who bring in the long-term asset to the mutual fund industry, they should be investing always, and I don't think it is worthwhile for them to be timing it. And there is a far greater premise for greater stability in the flows, because we are realizing that all the special events that used to trigger big massive inflows into mutual funds, those reasons are gone. Basically, the NFOs are gone. Pockets of a specific time period, incentive-driven sales, that is gone. So there is not an economic framework to support all that. So I visualize that investors should be investing regularly, and little bit of their allocation should be opportunistic, but largely their core portfolio accumulation, that should be on.
All right, Dhirendra, let's talk some more about debt funds, which have especially seen somewhat of a fall. Is this due to the new mark-to-market rule, according to you? And what's your advice to investors? Should they opt for equity funds or any other? Should they start looking at debt also?
There is always a role of fixed income in any investor's portfolio, but going by the AUM, I don't think you can draw any trend. The kind of people, the kind of institutions, the kind of companies who invest in these fixed income funds, they are not the kind of people who will ever invest in equity, and they should not invest in equity, because the only responsibility they have is to give the money back to their shareholder if they have to invest in equity. So this is not a fungible thing, and one should clearly be looking at individual investors, drawing conclusion from these AUM data. I think the only equity bit is relevant. Yes, the valuation norm did, the change in valuation methodology did trigger a scare, and no CFO will be able to settle for a decline of a nominal kind even for a day. It will cost him his job. So there was a scare, but now I think there is a greater stability. Of course, the new valuation norms, they are of a kind which have the potential to precipitate a disaster if we face October 2008, but then October 2008 is a calamity which happens every 10-15 years sometimes, and you can't really anticipate those.
All right, Dhirendra, then to the queries, and the first one coming in as an SMS from Sanjay Pandey, a businessman in Agra. Sanjay wants to know if this is the right time to invest in banking funds, and he's looking to know for new funds in which he can invest in.
It could be a good idea to invest in banking fund, but let me just put this in context that if you buy a Sensex fund, 25% of Sensex is banking. So you have to make a choice that should you be 25. If you own a diversified portfolio, a quarter of it is in banking anyway. So should you have 100%? And if you want to have 100%, there are decent bets. I would say benchmark B's, the banking ETF is a great choice. UTI banking fund is a great choice. So is the Reliance banking fund. So if he has to choose, he has credible vehicles to choose from. But I would say that make sure that it is not a huge part of your portfolio, because if you have a diversified portfolio through equity fund, it will be tilted to banking anyway.
All right, Sanjay, so make sure that it's not entirely tilted towards banking. But let's get into our second query, and in fact this is coming in from Ganesh Arora in New Delhi. He's a 43-year-old sales professional. He earns a monthly income of 60,000 rupees a month, and now wants to know some good debt funds that he can invest in for a time period of 6 to 7 years.
Debt fund for 6 to 7 years, I would say one can get little aggressive with one's debt allocation. If he is looking for a stability, I would say that he should consider a very conservative approach will be putting his money regularly in the growth plan of an MIP. That could be a nice way to accumulate, and he can get little aggressive with his MIP allocation, in the sense that the MIPs which have 20 to 30% equity allocation, And 6 to 7 years, I think there is a basis to really motivate him and persuade him to get little more venturesome.
All right, Dhirendra, thanks so much for answering those queries and being with us.